Welcome to the next session on the corporate finance or business finance part of it. Today we will talk about bond valuation and stock valuation. So we'll start with bond valuation. What is a bond? How do you value a bond? What are the important terminologies which are connected with the bond? Is all that what we are going to discuss as of today. So let us look at, in this particular case out here, let us start with what do you call it as definition of a bond out there. How do we even define a bond? Bond is a debt instrument. A debt instrument means it is legally binding agreement between the borrower and the lender. If a government issues the bond, government is the borrower. If public subscribe to the bond, public are the lenders to the particular bond. If an institution issues a bond, the institution is the borrower and people who are subscribing it. It can be again institutions, it can be individuals, it can be anybody. They are the people who basically are lenders to that bond. Please note, it is a bonds, number one, has a fixed tenure out. And fixed tenure means fixed life. It is not what is called, the bond is not perpetual. It has normally a fixed life. It can be 10 years, 15 years, 20 years, etc., etc., etc. It will have what is called, as you can see on the slide, a maturity date. A maturity date out there. Bond will have what we call it as a coupon rate and a coupon payment schedule also will be there. Normally, barring zero coupon bonds. Bonds will have, what is a coupon? Coupon rate is nothing but the rate of interest that the bond carries. The rate of interest could be anywhere depending on the market rate, depending on the risk factor, depending on who is the issuer, depending on who is the subscriber. The whole lot of things come into it, and then they decide what is called as the interest rate. For example, let us take, if you invest in a fixed deposit in State Bank of India, you get about 7% or 7.5% out interest out there. That 7 or 7.5% interest is what we call it as a coupon rate on this bond out there. That is what we say coupon rate. It is the annual coupon divided by the face value out there, that is expressed in a percentage. Coupon payment out there, that is, it weighs what is the frequency of this coupon payment. Is it annual? Is it what is called as is it monthly? Is it quarterly? Whatever it is, that is the coupon payment terms and conditions are also mentioned when they issue a bond. Normally, bonds will have a face value. That is the value at which the bond certificate is issued. It can be a 100 rupee bond, it can be a 1000 rupee bond, and so on and so forth. So that value on which the bond is denominated, if I have to use the word, the value in which the bond is denominated is what we call it as the face value of the bond or par value of the bond. Now that we know some of these basic aspects, we move to the next aspect. We take an example also, and I will try to explain all these things. Supposing a big corporation wants to borrow $1,000, that is, the bond is of value $1,000. That means, supposing big corporation wants to borrow $1,000 for 30 years. Now what is happening? They are issuing a bond for $1,000. The bond is denominated as $1,000 bond. Okay. So what happens? The face value of the bond is $1,000. What is the tenure of the bond? 30 years. That is, tenure of the bond. Maturity date will be the date 30 years hence. Maturity date is not 30 years as mentioned in the screen. Maturity date is the date which will be 30 years from the date of issue, out there. That is, 30 years in here becomes what we call it as the tenure of the bond out there. The interest rate will be similar to the debt instrument, and then issued by similar corporations is 12%. That means 12% is the coupon rate. 12% of 1000 is what you will get for the next 30 years every year. At what frequency will you get? Let us see that. Bank will thus pay 0.12, that is 120 interest every year for the 30 years out there. So, in this particular case, annual coupon payment is 120. Let us say coupon payment is yearly in this particular case. So, this basically gives the explanations of the terminologies. The third aspect, the next aspect out here, important aspect is bond values and yields. What are the values of the bond? What are the yields of the bond? And so on and so forth out. Let us sort of look at these aspects out there before we move further. Bonds and interest rates are related. That is, market interest rates are expected. Now, let us take an bond values and yields. Let us take some small examples and let us try and see if we can explain it with the help of that better. Suppose you say somebody comes up with what we call it as a 5-year bond. Now, the bond was issued, let us say, on 1/1/2020. That means maturity will be on 31/12/2024. 5 years, 20, 21, 22, 23, 24, 5 years. 5-year bond. Now, today that bond has a coupon rate, let us say a coupon rate of, let us say, 10%. Coupon rate of about 10% out there. The bond has a coupon rate of about 10%. The bond has a coupon rate of about 10% out there. And let us say the face value of the bond is, let us say, $100. Now, today, let us say 1st January 2023. 1st January 2023. That means the bond has a still life of 2 full years. That is at the end of the years. The bond is available for sale in the secondary market, as I said yesterday. Oh, let me tell you that. Bonds, please note, bonds are also tradable out there. Now, the company has issued a bond in 1/1/2020. Imagine I have bought that bond. I do not have to wait till 2024 to encash that bond. In between, if I want, I can sell that bond in the market out there. That is what we call it as a secondary market. Bonds are tradable. So, now the person who has bought the bond has earned 10% interest on that $100 bond for 3 years. That is 2020, 31st December 2020, he has got 10% return out there. 31st December 2021, he has got 10% return out there. 31st December 2022, he has got 10% return out there. 1st January 2023, he wants to say, I want to sell the bond because I need cash as of today. He is prepared to sell the bond in the secondary market. Now, the question is, at what price will you buy the bond? At what price will you buy the bond out there? Will you buy the bond because at the same $100? Will you buy the bond at a price which is lower than $100? Will you buy the bond at a price which is higher than $100? That is a key question that basically comes in out here. Now, that depends on what is the yield or I would say prevailing interest rate on a equally risky instrument in the market as on date of sale. As on date of, that means as of 1/1/2023, what is the prevailing interest rate on an equally risky instrument in the market? Supposing, imagine I want to purchase this bond, I go to the market to I am basically interested. Imagine I have some money. I have the choice of buying this bond from the person who is holding this bond, which has a coupon rate of 10%, and buying this bond and holding it for 2 more years, because I am looking at a 2-year investment option. Or I can invest in any other new bond which comes in for the 2-year tenure out there. I can invest in a new bond which is issued by the government or corporate or whatever it is, directly with a 2-year tenure out there. These are the 2 options I have. Now, how will I decide between these 2? I will decide between these 2 based on the prevailing interest rate. Supposing the bond, when I go to the market, I have an option of buying a bond directly from the government and etc., whatever it is, a fresh bond, new bond. And let us say the new bond is getting, what do you call it, as the new bond which is being issued on 1/1/2023 has a coupon of 12%. That means what I will do? Will I buy this bond at $100? No, because if I buy this bond at $100, I mean let us give a name to this particular bond out there. Let us give a name to this bond. This bond, let me name it as bond A. So if I buy the bond A, if I basically buy this bond A at $100, the face value, I will get only 10% return, that is, I will get only $10 with me. Whereas, if I buy the new bond which is being issued, and imagine the bond also has the same face value of $100 out there, this is bond B, I will get 12% return out there because return is going to be higher. So, I will not buy that bond in the market, I will rather go and buy the new bond, because the prevailing interest rate in the market, let me use the word again, prevailing interest rate in the market for similar risky instruments is 12%. Similar risky instruments is 12% out there. How do you say similar? There are factors to compare, don't worry about that. So, for example, that person, imagine the person who is willing to sell the bond is desperate to sell the bond because he needs money. So, at what price will he have to sell? He will have to sell it to me at a price that if I buy it, the yield what I will get will be exactly equal to at least 12% out there. Very simple. If let us say the bond what he is holding, if the bond the bond A has a face value of $100 out there, he has to sell it at a discount. Why has to sell it at a discount? Because the bond is issued, let us say the bond is issued by RBI. RBI will continue to pay 10% interest on that for the lifetime, that's all. It doesn't care who is holding the bond. You hold the bond for 3 years, you transfer it to me, now I will hold the bond for 2 more years, I will get the same 10% on that bond. So, but they will pay exactly 10% on this $100 out there that you have invested. So, what happens? Now, I am buying the bond and he is desperate to sell the bond. He will have to sell it to me at a price which is lower than the, basically what do you call it as, lower than the 10% out there, than $100 there. Why? Because what am I going to get? For example, on 31/12/2023 or 31/12/2024, what am I get? Coupon, I am going to get $10. Coupon, what I am going to get? $10. this $10 should be equal to 12% for me because that is the prevailing market rate. $10 should be equal to 12% for me because that is the prevailing market rate. If this $10 should be equal to 12% for me, then I should buy it at a price below 100. Only then it will be equal to 12% for me. So how do you decide? So what happens? I will just say, I will look at it. I will say, this $10 I'm going to get 1 year down the line. So I'm going to discount it for 1 year at 12% out there. This is the next $10 I'm going to get 1 year down the line. I'm going to discount it at 12% out there for 2 years. Plus the $100 I'm going to get at the end of 2 years out there. So I'm going to discount that also at 12% out there for 2 years out. So if you total this is what will be the value of them because my expected return is 12%. So I am discounting this $10 at 12%, which I am going to get at the end of 1 year. The next $10 I am going to get at the end of 2 years. I am discounting it for 2 years. And the $100, the coupon with the face value of the bond, which I am going to get at the end of it, 2 years. I am going to discount it at the same 12% because my expected return is 12% for 2 years out there. So what is this? If you basically do this, have you calculated, Suhail? Okay. So this is about 8.93 plus 3 plus 7.97 plus 79.71 out. So that should be equal to about 96.79. Yeah, it should be about 96 point something. 96.61. So I'll buy the bond at 96.61 so that the $10 what I get will be equal to 12% return. Now let us see, if I buy it at 10%, if I, for example, if for 96.61, if I get $10 every year, is this equal to what percentage? Can you calculate? 96.61, I am getting $10. So as a percentage, how much is it? 100 into 10 divided by 96.61. So if you buy this bond at 96.61, then for 2 years consistently, including the discounted value of the face value, what you are going to get and everything, your return is going to be about 12% out. Your return is going to be about 12% out. So what happens? The coupon rate of an equally risky instrument at the time of the sale of the bond is higher than the coupon rate of the bond which is up for sale. So what happens? You will have to buy the bond at a discount. Only then your yield will be equal to 12%. Supposing, let us say, the coupon rate of a 2-year bond is only 8%. Then the bond will sell at a premium. Bond A will sell at a premium. Why? Because the bond A is giving a coupon of 10%. Bond A is giving a coupon of 10%. Then what happens? What is the price you buy the bond? Very simple. The same $10 into 1 plus 0.8 plus $10 into 1 plus 0.8 square plus $100 into 1 plus 0.8, not 0.8, I'm sorry, I missed a 0 out here, not 0.8 square out. Not 0.8, okay, not 0.8 square out. So if you do this, this will be some 100 point something, 100, 104, 103 or whatever it is out there, some number will be there. So then that will be more than $100, more than the face value of the bond. Why? Because your expected return is only 8%. The bond is giving a coupon of 10%. So what happens? The bond you will buy it at a premium. So in short, what are we trying to say? We are trying to say that the price of the bond out there, the value of the bond in the secondary market will depend on the prevailing interest rates out there and the number of periods that are remaining until maturity, the value of the bond. If it is only one, then what happens? Why the time or period is also important? Very simple. Let's go to this case. This $100 coupon face value of the bond, you are going to get only after 2 years. So 2 years I discount. If it is 1 year, I discount it for 1 year. If it is for 10 years, I'll discount it for 10 years. So that also has an impact on what you're basically going to get as an overall gain out there. So it also depends, number one, on the prevailing interest rate as well as the coupon. The number of periods remaining of the maturity until maturity. The face value, the coupon and the market interest rates of the bond are they with similar features out there. Now the next aspect what we talk about is what we call it as yield of the bond. I talked to you briefly about yield of the bond, yearly yield, 10%, 12% yield, because my expectation is 12%, my expectation is 8%, that is the yield. Now we talk about the next aspect, what we call it as YTM, yield to maturity. The interest rates required in the market on the bond is also called bonds yield to maturity. In this particular case, yield to maturity, what is said, 12%. Till the date of maturity, yield to maturity out there. So let us look at the calculating the present value, and let's look at the next basic couple of aspects as of the bond as we go along out there. The next aspect we talk about is how do we value the bond. We did value the bond out there, that is whatever is the coupons you are going to get, discount value of that coupons plus whatever the principal you are going to get back, the discounted value of that, that is whatever is the time period along with it. The summation of this whole thing is what we call as the value of the bond out there. It is determined by the present value of coupon payments and par value. That is what we talk about. Interest rates inversely related to the present bond values. Present values of the bond inversely related. Obviously, you know interest rates, how it is inversely related out here. Pricing of the bond value. What I did was a very simple case out there. Let's explain this. What do you call it as this equation looks a little complex for you. Let me not look at the equation. Let us try and solve a problem. Suppose a Xanth company were to issue a bond for 10 years to maturity. The bond has an annual coupon of $80, implying bond will pay $80 per year for the next 10 years in coupon interest. Annual coupon is 80, it will pay $80 for the next 10 years. In addition, they will pay $1,000 to the bondholder in 10 years. That is, at the end of 10 years, they will pay $1,000 to the bondholder. That is the face value of the bond. Assuming similar bonds have a yield of 8%, what is the price at which this bond should sell for? We can say that the bond is giving $80 per year, face value of the bond is giving exactly 8% out there. We can say that out here. So when the bond is giving 8%, yields on the similar risky instruments is also 8%. So ideally, what price should the bond sell with? It should sell at par value. It should sell at the same value. If this is 9%, that is, assuming similar bonds have a yield of 9%, then the bond will sell at a price lower than 1,000. Similar bonds have a yield of only 7%, then the bond will sell at a value which is higher than 1,000. So let us take this. Let us, though I said it will sell at a par value, how do we calculate it? Let's sort of look at the calculation part of it also out there. Let me go to an Excel sheet. First of all, what happens when we are looking at in this particular case, if I have to go back here, what does it say? What price will the bond sell for? Now let us look at first and foremost is the present value of the face value. Present value of the face value. I am going to calculate this present value of the face value. When are you going to get the face value? The face value is going to come only at the end of the 10th year, and this is the face value that I am going to get. At what rate do I discount out there? I am going to discount it at the rate of what you call it as 8%, because 1 plus R, 1 plus 8% out there, because the expected return on equally risky instruments is 8%. After what period I am going to get, what is the T out there, number of years after which I am going to get, I am going to get at the end of 10 years out there. So, what is the face value, present value of the face value of the bond? Present value of the face value of the bond is what I have calculated, 463. Is 463. Next, let us look at present value of the annuity. Annuity means what? All the $80 interest rate you are getting every year for the next 10 years. What is the present value of that money? That is all what we have to look at. So, how do we calculate present value of annuity out here? We have given a very simple formula in this case. We talked about annuity in the last class. We are going to use that. Let us sort of look at in this particular case. Let us sort of try and see if we can solve it. What is the coupon? Coupon every year is $80. What is the R? R is the interest rate. Interest rate is 8% out there. I have basically talked about that. Then let us look at it. It says 1 minus 1 by 1 plus R. In this particular case, what is R? R is again 8% to the power of, what do you call it as, 10 years I am going to get to the power of T, and that is what we are basically going to do out here in this particular case. I think I've closed all the brackets. Yeah. Okay, I need to close on. Yes. So, what happens? I have basically calculated the present value of the annuity. So, what happens? The total bond value will be sum of present value of the annuity plus present value of the face value of the bond, 100,000. Because in this case, what does it say? It says that similar bonds have a yield of 8%, and this is also giving 8% yield, because $1,000, $1,000 bond, and $80 is what you are getting every month, every year. So 8%. So what happens? The value of the bond is at par. I said it's at par.